Hi, and welcome to Midas Investing. Today, we're going to be taking a look at Advanced Auto Parts, ticker AAP. This stock has seen a little bit of a decline recently with a decrease in its guidance as well as a cut in its dividend. We're going to be taking a look at this company and seeing whether or not a turnaround opportunity exists and how I'm thinking about it for the future. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So hopping right into their first quarter release, we have the president, Tom Greco, who is also going to be retiring here this year and is looking for a new CEO. They're in transition stage. I thought it was kind of interesting that Mr. Greco chose to cut the dividend this quarter when he himself is still the CEO, rather than allow for the new CEO to have that on his own record. A little bit of a decent following on his own sword kind of moment. Also reporting very, very low operating margins relative to expectations, which he argues that is due to higher spending towards planned investments to improve their competitiveness in the future, i.e. building up of working capital and other such and strategic capital expenditures and stuff like that. As I was saying, with the cut of their dividend and the changeover in management, it's basically like they're trying to clean the slate for the future. And this comes also, though, unfortunately, at the same time as them cutting their guidance for the year pretty significantly from what they had previously reported at the Q4 presentation, bringing it down closer to about 11 billion for the 2023 numbers. And analysts themselves are seeing it a little bit more pessimistic than that. In the short run, my revenue assumptions will be in line with analysts, which basically assumes something closer to 11 billion. Also assuming that the operating margins will be a bit lower than the previous guidance as well. While I'm looking at Advanced Auto Parts because I see it as a good turnaround play, it's worth noting that a lot of this valuation is built around my assumptions and my beliefs about the opportunity in the industry itself. Looking here at this article from S&P Global, we have a chart showing the average vehicle age by type in the United States, split off by cars and light trucks. You can see it has grown dramatically over the last decade. Not only is it high in absolute terms, but it's continued to just grow over this time frame. And this is all at the same time that we've actually had pretty significant car sales, which I'll show on a graph here in a few minutes, has been up for the last decade at about 60% of the current registered car fleet in the United States, meaning that there is about 60, we can say 50% to make it simple, 50% of cars are on average maybe about 5 years old, whereas there's going to be another 50% of cars that are going to be probably more like 18 to 20 years old in order to achieve these overall averages right here. The point of that is to show that there's a short-term need for auto repair with those extremely old cars, those 15 to 20-year-old cars, but there's also this burgeoning demand in the future coming from these cars themselves that are recently been purchased, the 60% I was talking about in the most recent years as well. So the point is there's actually large demand for auto repair going for the coming several decades. Now, obviously, one other part of the equation when it comes to demand for auto repair is the supposed coming EV revolution. Now, I found this large presentation from the IEA surrounding the global EV outlook in general. Covers a whole bunch of information. The packet's 142 pages long. I'd suggest you guys go and look at it if you're interested in taking a look at some information about this. But I really wanted to dive into this report in particular to try to get an idea of just how much expected decline in auto repair we might be able to see over the next decade if this EV revolution is supposedly going to take off. Now here you can see EV sales over the last decade or so, and in the last year in the United States, it made up about 5 to 7% of the total car sales and about 0.5% to 1% of the total cars registered in the United States. And it's like closer to 5 to 7% globally for the whole numbers as well, and that's looking to increase significantly in 2023. You can see that on global terms, it does make up a pretty large majority in China, which is one thing to keep in mind. But nonetheless, as I was just saying, the US and global numbers in terms of sales and numbers of total registered cars is actually pretty equal, currently speaking. But the one thing I was trying to figure out of whether or not auto repair is going to be affected by the growing EV sales over the next coming decade was going to be more about the growth of this share over time, whether or not we're going to be able to see electric cars actually take off and become the majority of vehicles, and if it's going to happen fast enough that people would disperse of their previously purchased vehicles in favor of the new EV cars. And one thing that is important for building up the EV space in general is the charging points. And while charging seems to be keeping pace with sales at a relatively fast pace, one thing that I discovered when looking into this data is that the actual capacity of the charging stations itself doesn't seem to be keeping ground as much as we need. If you come down to this chart here, it shows on the blue bars, which is against the bottom axis, it shows the total amount of electric vehicles that they have per charge point. You can see that there's some countries that have relatively large amount of electric vehicles per charge point, and some that have lesser, with the world kind of being at this point on average about 10. But then there's also the average kilowatt per public charging per electric LDV. It's basically giving us an indication of the ratio of how much charging there is at each location relative to the amount of cars, relative to the amount that's going to be needed. And on average, the world in general is around a ratio of 1, which is approximately where you would theoretically need to be, but that's at the current amount of cars and the current amount of usage. So this doesn't take into account the supposed growth of this share from the 5 to 7% to more than 50%. Which means that we would need to grow the size of our electric grid by a commensurate scale. What the end point I'm trying to make here is that I don't really think that the electric vehicle revolution can actually become a majority of our fleet vehicles, at least here in the United States, for far more than a decade, unless there's going to be a revolution in electric generation as well. So coming over to this spreadsheet with where I built my model for AAP, we can take a look at some general metrics surrounding the industry. On the left axis and the blue area shade, we have the average amount of miles being traveled in the United States per registration in the United States. And this is something that I found when doing my research, is that this ratio is remarkably stable over a 30-year period. This chart going back to 1995. It's going down a little bit in the most recent decade or so, but relatively not so much. And that's with a pretty commensurate increase in registrations over the entire time frame. And I thought that was pretty interesting, that it's pretty equally tied to the registrations. Americans just like to travel. Well, with that, you can also see with the slow creep down in the miles per registration, you can also see a very, very slow creep up in registrations as a percentage of the population. We have the percentage figures here on the right axis. In general, the ratio of registrations to population has gone from the sub 80 range to well over the 80 range, and then it's kind of dipped back down a little bit and then continued on upward. You could argue this one's a little bit more of a consistent upward trend. But between the two charts, which the information between the two gets us to the ability to make a projection for the total amount of miles being traveled relative to each population as well, that I would say on average balance itself out. Now, the other two lines on this chart we have here on the bottom is the sales as a percentage of registrations. And this is what I was talking about before, is that you can see that consistently on any given year, there's typically kind of like 4, 5, 6, 7% of car sales being made as a percentage of the total registrations. And then if you add that up on a rolling 10-year basis, you can see that over the last 10 years, there's been 60% of all the registered cars recently purchased. Now, there is a little bit of an assumption being made here, is that each car being purchased in a given year is only replacing one of the registrations. Now, one person could buy one car in 1 year and also buy another car the next year. So this is very much a generalized average. There is some fuzziness in that number, but nonetheless, it gives you an idea of just how many new cars are being purchased relative to the actual registrations. And honestly, like I was saying, if that effect was happening, if people were buying multiple cars year after year after year, that would actually just increase the effect of what percentage of the cars are at an older age, and i.e. needing more auto repair. Now, coming over to this next chart, I take some of the information from the previous chart and kind of combine it together. And we on the bars have the retail industry sales dollars per mile traveled. We have the miles traveled per registration, and now getting an idea of how much sales in the industry is there in total per mile traveled. My logic behind this being that every mile traveled increases the need for auto repair a little bit more wear and tear on the vehicles. And I think that there was a pretty strong correlation between the two. I have the year over year of the bars in this dark blue line that we have right here. And then the green line that you can see, which is very highly correlated with it, is the industry year over year as well. So you can see there is a pretty strong correlation between the two. And the reason the correlation is so strong is because, like I was showing you on the previous chart, the average amount of miles driven by Americans is pretty consistent over time. If it wasn't consistent over time, then you would see a larger divergence here. Now, jumping down into the industry itself and taking a look at the major players, we obviously have Advanced Auto Parts, which is the purple shaded section kind of here in the middle, but also I have in red AutoZone, which is one of the larger of the players, as well as O'Reilly's, which is also one of the larger players in the red and the pink shades. And then in the blue, we have basically all of the rest of the revenues in that industry. It's worth noting that this industry grouping, which I get from ASWAT, the Motor Runs dataset, is a little bit fuzzy. It includes technically some companies that aren't super comparable with these ones, some things like gas stations and as well as actual auto sales for retails. But for the most part, the sales likely correlate well with this. And also considering the previous chart where I showed you the correlations line up well, that should give an indication that I think it works out well. So not to mention that sales of those particular things would coincide and correlate well with these companies as well. So I feel fine using that industry as my proxy. But nonetheless, you can take a look at the shares here. You can see that in general, Advanced Auto Parts is at a relatively small percentage of the share here in general, kind of like at 6% on average over time, which has decreased over the last couple of years down to 4%, which doesn't sound very good that they would have their share decreasing. That should be a very worrying sign. It might explain some of the decrease in the stock price, except that the major players have also had decreases. AutoZone down from 8 to 6%, as well as O'Reilly's down from 7 to 5%. So really you can see that in general, it's that the other category went from 80 to 85% over the last couple years. And this is part of the basis of my theory of why I think Advanced Auto Parts can be a very strong player, even if they might not be one of the strongest players in their industry. In fact, I would generally think of AutoZone as a much stronger player and O'Reilly's maybe as a second place one. I did actually take a brief look at the valuations of both of those companies while looking at Advance as well, but both of them seemed extremely overvalued to me, and I didn't want to make a full video for them. So you can take my word for it there or not. I chose to take a look at what seemed to me like the actual value opportunity. But part of the reason that I'm willing to accept the lower quality player in this space is a little bit of a game theoretic approach to this industry, wherein that I'm looking at this 80% that went to 85%, and I'm actually assuming that that's got to mean revert over time for a variety of reasons. I think that the supply constraints over the last couple of years drove a lot of the people who purchased from these companies, in particular a lot of auto professionals, that made them move towards some of the other smaller players, and then over time they might start to move back towards the larger players. Not to mention, I think that the smaller players might run into some economic troubles if they've had their profits accelerate too recently and they levered up too much. They might put themselves at risk of going out of business or being acquired by other players. But like I said, that's a little bit of a game theory kind of way of looking at this industry in the short run. We're basically just going to assume that things move in accordance with their long-term averages. So coming over to take a look at the average revenues and margins for each of these players within the industry. It's a little bit of a colorful graph, but I needed all the colors to kind of make the point of it, so bear with me. Still with the pink for O'Reilly, red for AutoZone, and purple for Advance, with green now for the average revenue of the other. I took the total revenues of the other grouping and then divided it by the amount of companies in that industry data set to get an average number of revenue for each of those, just get an idea of the sense of scale. So you can see AutoZone is indeed the larger player, followed by O'Reilly's, and then Advance is significantly smaller than that, although they were a bit closer back in the past. And then the average other is significantly smaller, which drives with the kind of the points I was talking about. But then I also included the operating margins as well here against the right axis for each of these companies as well. And you can see that O'Reilly's and AutoZone has significantly stronger operating margins than Advanced Auto Parts does, here down in the kind of the single digits range. But what's interesting, and it goes again with the theory that I was just talking about, is that the average other is significantly lower margins as well. So they're in a little bit of a thinner operating position, putting them at a higher potential weakness. So if they've had a higher increase in their revenue over the short run, that means that they've had a much sharper increase in their operating income over the short run, which, depending on how well they've managed their financials with that operating income, could put them at risk of over leveraging themselves or overextending themselves operationally or something like that. Now, the one question you should be asking yourself is, why is there this huge divergence between O'Reilly's, AutoZone, and Advance? That should be, like I said, a worrying sign. And I did identify what I think is the primary reason for why we have this divergence between the three major players, which is to say their difference between their DIY sales and their professional sales. So still keeping with the pink for O'Reilly's, red for AutoZone, and purple for Advanced Auto Parts, you can see in the shades, I still have the operating margins, but now in the shaded area background is the percentage against and the other axis for their DIY percentage of sales. You can see that AutoZone has the largest DIY percentage of sales at around 75% on average over this time frame. And then below that, we have O'Reilly's, which is more in like the 60% range. Still, so a bit lower than AutoZone's, which they still have relatively similar margins, but nonetheless, that's still pretty close in range with that. But significantly lower than that is Advance, less than 50%. In fact, in all of their presentations, Advanced Auto Parts positions it as being professional first. They focus themselves on the professional business much more than the DIY sales. And why this is important to understand for margins in particular is because you got to think about like why would the DIY users be going to the auto parts store in the first place? More likely than not, it's because they've had some sort of emergency with their vehicle. They've had some sort of problem to come up very quickly, and they need it solved now. This isn't regular routine maintenance. They need it solved now. And that immediacy gets them the higher margins. So there's going to be higher margins on a lot of those products because of the immediacy in this. You can listen to AutoZone's earnings calls and they talk about this. So that I think that explains why that there is this difference between the operating margins, is that Advance is focused much more on the professionals, which means that the professionals is going to have a little bit better pricing power generally over the long run. But you could argue that focusing on the professional gives them a little bit more of an advantage in terms of becoming the favorite of the professional. Maybe the professional, when times are tough and when the parts aren't available, will opt towards those other smaller players. But then when times get back towards a more normal time frame, they might opt to get into a good working relationship with the tried and true professional preferred player, which might be Advance. Now, there's one other important factor that I discovered when looking through their financials that might explain the large differences between their operating income margins, which has to do with a difference between how they are categorizing different expenses. They are primarily using the LIFO method for reporting their inventories, which is last in, first out, versus FIFO, first in, first out. The majority of companies, and according to the GAAP accounting practices, record their inventories in FIFO, because this creates a system where the original purchases get put out first, and then you have the most recent purchases kept on your balance sheet. And if you have costs that are continuing to move upward over time and you have an inventory that's constantly being drained out over time, then this makes sense as a way to make a regular calculation of the profitability within your most recent quarter, while at the same time making a longer term profitability metric that makes sense over the long term. The difference in the auto parts industry is that inventories for an auto part company or a company that is supplying auto part repair in general, is that they are going to have these inventories built up as a way of having the competitive advantage in order to supply the parts needed at the right time. As I was saying, there's a lot of emergency repair, so having the right part for the right model at the right time is important, and these parts don't wear down over time. They might become outmoded a little bit, but they don't wear out by sitting on the shelf. So what this does is that it makes it so that if you use the LIFO, which basically says that the products that you purchased most recently, which is probably in accordance with orders on hand specifically for the transactions you're currently doing, that means that by recording your profitability using LIFO, you're probably actually going to get a much more accurate representation of the profitability in your current quarter, because the FIFO, which would talk about the purchases you made maybe several years ago, those purchases were actually made at an appropriate level. They weren't necessarily some far back purchase that now needs to be normalized. It's actually something where those purchases, since they didn't wear out, they were basically just waiting for the right time for that purchase to occur. So the point is that there's this large divergence between their operating income according to the GAAP measure, as well as their adjusted operating income that we can see over the 5 years that they list right here, going from 6.1% up to a high of 7.6%, now down to 6.4% where it currently is. If we look at it with the adjusted measures, it had a low of 7.4%, coming up to a high of 9.6%, and then it's currently in 2022, at the end of 2022, was down to 9.8%. I am using generally closer to a GAAP measure for my operating margins, but the point is that with this assumption underlying it, the fact that I'm using GAAP means that over the long run, some of these divergences might just show up in the future years. So there's some reason to believe that their operating margins on GAAP basis would increase a little bit in future years as some of these factors start to normalize themselves over time. That is to say that I'm going to be relying on some longer term averages of their margins, but that might be a very conservative assumption with this information. All right, now, so taking a look at my actual model that I built for the company, we have at the top the US population and projections according to the government of where it's going to be in 2032. And then, as I had shown, we have the US registrations in total and the percentage of the population that they have been over time. On average, it's been about 82% with a deviation of about 2.3%. And we're basically just going to assume that that average sticks, with our bear and bull cases being one deviation away from that. And in general, a lot of my bear and bull cases are going to be essentially one or one standard deviation plus or minus, depending on whether that applies to a bull or bear case for any of these metrics down this line. Then I show the auto sales and the percentage of those registers, which is where I got the percentages that I showed in the charts. The miles as a ratio of the registrations, which, as I was showing, in general has been about 12,000 pretty consistently over 30 years, and the deviation of a few hundred miles or so. And we're going to assume that that ratio generally sticks over the long run as well. So based off of that, we're going to assume that it's basically still going to be about 12,000 miles per registration in 2032. And if we take those assumptions together, that brings us up to about 3.3 trillion miles driven, or 3.7 trillion, depending on the bear or bull case. And so based off of that, we can then build up from our ratio of the auto retail sales per mile, which we had shown had grown at a pretty rapid rate, which was commensurate with the auto retail sales of the industry. Over the last several years, on average, it has been 6.4%. However, if we come back to the 2019 period and look at the rate of growth up through 2019, it was 1.7%. So you can see that inflation had a very substantial impact on the auto retail dollars per mile driven. And so with that in mind, I didn't want to assume that this average was going to maintain itself over time. I chose to be a little bit more conservative and assume that this 6.4% is actually going to be more like the bull case assumption there. And then 1.7% would be more like the typical bear case assumption. And I chose halfway between that for my base case there. Which gets us about 7 cents per mile driven, or about 10 cents per mile driven. Either way, if I build up from the total miles that we have, that brings us up to about 217 billion in the bear case for the auto retail sales in the United States, or possibly 382 billion in the bull case scenario. So that's going to be our total industry size, from which we're going to then get our sales for advanced auto parts, as well as the other players within the industry. Because the way I chose to build up this model was basically top down from the industry. We're just looking at the total industry and then apportioning different shares to the different companies within the industry based off of the kind of strategic approach that I outlined when I was looking at those charts. So we have O'Reilly's, which on average over the last several years has had a market share of about 6%, which is deviated by about 0.5% or so. We're going to assume that they come back up to this average of 6%, deviating by about 0.5%, give or take, which should be understood is an increase from where they most recently were. They were most recently around 5%. So we're assuming they're going to come back up to their longer term average in terms of market share. We're going to assume very similarly for their operating margins. Their operating margins, they had on average was about 19.4%, most recently about 20.6%. Now for the margins, when it comes to the other players in this industry, I'm going to assume that they actually are going to stay closer to their more recent margin if it had a higher margin. We'll basically choose between the higher of the average or the most recent, and we'll assume that the other players are going to have the better of the two. Whereas for advanced auto parts, you'll see that I'm going to choose the more conservative of the two. And the reason why is I'm going to show how this affects their operating incomes individually. But for the revenues, we're basically just going to assume that they return to their longer term averages. So for AutoZone, though, then that means that AutoZone on average had about 7% market share. We're going to assume that it returns that 7% market share, give or take about 0.5% or so. And then likewise, the better of the two of their most recent margin or their longer term margin, which for them was also about 20% or so, deviating by about 0.5% or so. Now coming down to the other category, this is, as I had said, the other revenues, not counting advanced auto parts, not counting O'Reilly's, and not counting AutoZone. That left about 180 billion in 2032 in the bear case, or possibly 306 billion in the bull case. If we likewise assume that they're going to come back towards their longer term average of market share, which would bring them down from this 85%, possibly closer to this 81%, which was their longer term. Now I'm actually going to assume that maybe they don't come all the way down to this 81%. Maybe they only come sort of halfway between that. So I essentially have the bear case be that they are only going to change from their current levels down by one deviation, and then likewise down one more deviation to the base case, and then down one more deviation in the bull case. So in the bull case, they would actually be a little bit below their longer term average, but in the bear and base case, they in general stay above the longer term average. So while I do think this kind of strategic approach of how the shares over the whole industry is likely to occur, that is basically my case for the revenues here at Advanced Auto Parts, I am still going to be kind of conservative in that assumption. But like I would say with the margins though, I will choose the higher of the two between their most recent and their longer term average, which most recently was close to 4%. So we're assuming that that remains at about that 4%, deviating by about 0.5% either way. Now, likewise, what does that leave left over for Advanced Auto Parts? We basically did all the others, made assumptions for AutoZone, for O'Reilly's, and for the other, and then that leaves what's left over for Advance. And then that leaves us with the assumption that in the bear case, they have about 5.2% market share. In the bull case, they end up with 6.1% market share. In the base case, that leaves them at 5.7%. It's worth noting again that they currently had about 4%, and then on average over the last 10 years, they had about 5.9%. So in general, we're assuming that they're a little bit less than their average, but that they come pretty close up towards that average over the next 10 years. And then, like I said, with the operating margins, for them, I chose the lesser between the most recent or the longer term average, which means most recently it was 6.8%. And then I chose to allow it to deviate by the deviation amount, which for them was actually about 1% or so. Now, the reason why I took a look at these operating income levels for the other of the companies as well as Advanced Auto Parts is that I wanted to kind of show that the potential deviation in the operating income levels for each of these companies. Now I have this ratio here, which is the ratio of the average difference between the three outcomes of operating income and their most recent operating income, showing basically on average, how much can we possibly expect their operating income to increase over the next decade for each of these cases. For O'Reilly's, it's about 23%. For AutoZone, it's about 28%. For the other category, it's about 23%. And for Advanced Auto Parts, it's about 59%. Now, again, keep in mind with Advance, we chose to make a slightly more conservative assumption about their margins than we did for the other three players. And then we still ended up with this much upside difference. So imagine if I had used the same assumption, this number would be even higher. Or if I had used the same assumption as this one for the other three, these numbers would be even lower. And now getting back to the kind of game theoretic approach that I was talking about in terms of the other category previously getting a large increase in their share, and my assumption that they might start to lose that share over the next few years. If we take a look, in the most recent few years, the operating income on average across these players had shot up from in the kind of 100 millions range to well over 200 million to well into 300 millions. And then now, even in the base case assumption, they might have difficulty maintaining that level. Again, this is somewhat true for the other players as well, but considering how much smaller these players are, I think that puts them at a serious risk of running into financial troubles along the way, which means that they could be in a position to possibly be acquired by one of these larger players. Which would open up the share opportunity to spread out to other players. So the point is I really do see it very likely that these smaller players are going to come back down over time to their longer term average, especially since it deviates so significantly from that longer term average. So anyway, with those assumptions about the market share though, for the retail auto space in the United States, that means that at about 5.2% market share, that would give Advanced Auto Parts about 11.3 billion in revenue in the bear case assumption of 2032. And in the bull case assumption of about 6.1% market share of 2032 revenues, that would give them 23.4 billion potentially, with the base case finding it somewhere in the middle there at about 16.3, 16.4 billion. So these are going to be the assumptions that I'm going to use for my valuation model. And switching over to the DCF template, we can take a look at the revenues right here. I have those numbers as I had just showed you here in the terminal cases for the bull, base, and bear case assumptions. In the short term, I have the averages pretty close to where the analyst expectations are, give or take a little bit. And you can come down to the graph to see how the cumulative growth cases look over time with the incremental growth cases here. And coming over to take a look at operating margins, you can see that for the first 5 years, I have average operating margins of around 7%, with it being closer to 5% in the short term, getting us kind of close to, like I said, those kind of analyst expectations. I am assuming that, like I said, the LIFO numbers will start to normalize into their operating income over time, but I am assuming that's going to take several years for it to get that effect into the system. And then for the next 5 years after that, we'll be closer to about 7.5%. So you'll see that kick in somewhere in that back half there. And then we'll have an ending terminal assumption of about 7.2%, which is a bit lower than the longer term average margin had been over the last decade, which I think was a pretty conservative assumption. Coming down here, you can see how those operating margins move over time on this graph here, with operating income quartiles as well. And then the terminal case operating income distribution right here. Majority of the outcomes kind of here in like the 750 to 1 billion range, but there is plenty of upside potential all the way up to close to 2 billion. And taking a look at free cash flows and total capital expenditures, we have free cash flow levels in the range of about 400 million on average for the next 5 years, and then increasing to about 700 million on average for the next 5 years after that, ending at perhaps a little bit lower than that in the terminal case. Returns on invested capital for the first 5 years, it'll be in around the range of around 9%, and then increasing to around 10 to 11%, ending at about 10%. Coming down here, you can see those as well, returns on invested capital quartiles and the free cash flow distribution in the terminal year, stretching from around 500 million to a little bit less than a billion, with the vast majority of the outcomes. And taking a look at the terminal assumptions, you can see the implied terminal multiple of my discount rate assumptions has it kind of between about a 12 and an 18 for the vast majority of the cases, but maybe a 14, 15 on average, with the majority of the valuation outcomes showing up between about 66 and $112 per share. So about 50% of the valuation outcomes in between those quartiles, with about 25% below that and then 25% above that. The average expected outcome about $89. You can see the valuation distribution here. And coming over to the expected case summary page, you can see that right here. It's currently trading at about $72 per share, with the current fair value at around $89 per share. That means it's trading at the 33rd percentile of the value distribution, which means there's 3 times as many outcomes to the upside as there is to the downside. About 13% expected returns, about 23% upside to fair value. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. That's going to do it for our evaluation of Advanced Auto Parts. I did actually already take a small position in this company prior to getting this video out, and I'm excited to be building this position out. I definitely think that it should remain not a very large position within the portfolio, because while we do see some significant opportunity here, as I kind of laid out, it very much involves the actions of other companies and the industry as a whole. So it's not entirely something that I can rely on the operational excellence of Advance for, and it's more about the disconnect between the price and the value as I see it currently. I'll catch you all in the next valuation. Bye.